Most retirees lose thousands of dollars to the IRS not because they did anything wrong, but because no one ever explained this one home tax rule to them. They sell the house they lived in for decades, the house they raised their kids in, the house they paid off years ago, and then a tax bill shows up that they never saw coming. And the worst part is this tax bill was 100% avoidable. If you're retired, close to retirement, or planning to sell your home someday, what I'm about to explain could save you more money than any investment tip you've ever heard. Stay with me till the end of this video because missing just one small detail could cost you tens of thousands of dollars. Before we continue, I want to say something directly to you. This channel is built for people like you. People who worked hard their whole life, who want clear and honest explanations, and who don't want to be surprised by the IRS later. I don't make videos to confuse you or sell you hype. I make videos to protect your money, your retirement, and your peace of mind. If that sounds like something you want, then this channel is for you. I regularly upload videos on retirement taxes, Social Security, IRS rules, and money topics that most people don't explain in plain English. If you don't want to miss future videos like this, just hit the subscribe button now. It's free. It takes 1 second and it helps make sure these videos keep coming straight to you. I'll be uploading more on this exact topic, breaking it down step by step. So subscribing now makes it easy for you to stay updated. Most retirees believe that once they stop working, taxes become simpler and lighter, especially when it comes to their home. Many people think their house is automatically tax-free because they lived in it for decades, raised their family there, and paid off the mortgage years ago. This belief feels logical, and for a long time, people repeated it without ever questioning it. But the truth is, the IRS has very specific rules about what happens when you sell your home. Snorts and many retirees do not fully understand those rules until it is too late. This lack of understanding can sometimes cost people tens of thousands of dollars, or at least create a shocking tax bill they never expected. The rule that confuses most retirees has to do with something called capital gains tax on a home sale. Capital gains simply means the profit you make when you sell something for more than you paid for it. If you bought your home many years ago for a low price and sell it today for a much higher price, the difference between those two numbers is considered a gain. The IRS normally taxes gains like this, but there is a special rule for primary homes that can protect a large portion of that profit. This is where many retirees hear part of the rule, but not the full story. Under current IRS rules, when you sell your main home, you may be able to exclude or completely avoid paying tax on a large amount of your profit. If you are single, the IRS allows you to exclude up to $250,000 of profit from taxes. If you are married and filing jointly, that number jumps to $500,000. This sounds very generous, and in many cases, it truly is. For retirees who bought modest homes years ago and sell them for a reasonable gain, this exclusion can mean paying no federal tax at all on the sale. However, this exclusion is not automatic and it is not unlimited. The IRS sets clear conditions that must be met before you qualify. One of the biggest conditions is that the home must have been your primary residence. This means it must be the place where you actually lived most of the time, not just a property you owned. The IRS looks at where you received mail, where you were registered to vote, where your driver's license lists your address, and where you spent most of your time. Another important condition is the timing rule, often called the 2 out of 5 year rule. To qualify for the exclusion, you must have owned the home and lived in it as your main residence for at least 2 years during the 5 years before the sale. Those 2 years do not have to be continuous, but they must add up to at least 24 months. This is where many retirees accidentally break the rule without realizing it. For example, some retirees move into a smaller place, move in with family, or relocate to another state for health reasons. They may keep their old home for a few years and then decide to sell it later. By the time they sell, more than 3 years may have passed since they actually lived there. Even though they owned the home for decades, they no longer meet the 2 out of 5 year rule. When that happens, the exclusion may no longer apply, and the IRS may treat the entire profit as taxable. Snorts. Another issue that surprises retirees is how much their home has increased in value. Many people bought their homes in the 1980s or 1990s for prices that now seem incredibly low. A house bought for $100,000 decades ago might sell today for $6 or $700,000 or even more in some areas. On paper, that looks like a huge gain. While the exclusion covers a big part of it, it does not cover everything if the profit exceeds the allowed limit. Let's say a married couple bought their home for $150,000 and sell it for $800,000. That is a profit of $650,000. The IRS allows them to exclude up to $500,000, but the remaining $150,000 may be taxable. Many retirees assume the entire sale is tax-free and are shocked to learn that part of it may still be taxed as a capital gain. Another thing retirees often misunderstand is the difference between purchase price and taxable profit. The IRS does not simply look at what you paid for the house and what you sold it for. There is something called cost basis, which is the starting value used to calculate gain. Your cost basis usually begins with the price you paid for the home, but it can increase over time if you made major improvements. This is an area where many retirees miss out on tax savings simply because they did not keep records. Major home improvements such as adding a room, remodeling a kitchen, replacing a roof, or upgrading plumbing or electrical systems can increase your cost basis. This means the IRS sees your investment in the home as higher, which reduces your taxable gain. Unfortunately, many retirees do not keep receipts or documentation for improvements made decades ago. Without proof, those costs cannot be added to the basis, and the taxable gain appears larger than it really should be. There is also confusion about what counts as an improvement versus a repair. Routine maintenance like painting, fixing a leak, or replacing a broken appliance usually does not count. Improvements are changes that add value to the home, extend its life, or adapt it to new uses. Understanding this difference can make a significant difference in how much tax you owe when you sell. Another situation that often catches retirees off guard involves second homes and vacation properties. Some people assume the same exclusion applies automatically, but that is not the case. The exclusion only applies to your primary residence. A vacation home, rental property, or investment property does not qualify unless specific steps are taken. However, there is a strategy that some retirees can use if they plan carefully. If a retiree owns a vacation home and decides to make it their primary residence, they may be able to qualify for a partial exclusion. This requires actually living in the home as the main residence and meeting the 2 out of 5-year rule before selling. Even then, the IRS may prorate the exclusion based on how long the home was used as a primary residence versus a rental or vacation property. This is complicated and often misunderstood, but when done correctly, it can still reduce taxes significantly. Another overlooked factor is how selling a home affects other taxes. Even if part of the profit is excluded, the taxable portion can increase your overall income for the year. This can push you into a higher tax bracket, increase taxes on Social Security benefits, or raise Medicare premiums. Retirees often focus only on the home sale tax itself and forget how it interacts with the rest of their financial picture. Timing also plays a role. Selling in a year when your income is lower can reduce the tax rate applied to any taxable gain. For example, if you recently retired and your income dropped compared to your working years, selling after retirement might result in lower taxes. On the other hand, selling during a year with high income from pensions, required minimum distributions, or other sources may increase your tax burden. Another important detail is that the exclusion is not something you can use unlimited times. While it is possible to use it more than once in your lifetime, you generally cannot use it more than once every 2 years. This matters for retirees who move frequently or sell and buy homes within short periods. Failing to understand this rule can lead to unexpected tax bills. Divorce and the death of a spouse can also affect how the exclusion applies. In some cases, a surviving spouse may still qualify for the higher $500,000 exclusion if the home is sold within a certain time after the spouse's death and other conditions are met. These rules are complex and often misunderstood during emotionally difficult times, which is why planning ahead is so important. Many retirees assume the IRS will automatically apply the exclusion correctly, but mistakes can happen, especially if paperwork is incomplete or inaccurate. It is important to report the sale properly, even if no tax is owed. Failing to do so can trigger letters from the IRS, delays, or penalties. The biggest takeaway for retirees is that selling a home is not just a real estate decision. It is also a major tax event. Understanding the rules ahead of time allows people to make better decisions, avoid surprises, and keep more of their hard-earned money. A little planning can go a long way. This is why financial advisors and tax professionals often recommend reviewing home sale plans years in advance, not months. Knowing when to sell, how long to live in the home, what records to keep, and how the sale fits into overall retirement income can make a dramatic difference. For many retirees, their home is their largest asset. Treating its sale casually or assuming it is completely tax-free can be a costly mistake. The IRS rules are not designed to punish retirees, but they are very specific, and ignoring the details does not make them go away. Understanding this one IRS home tax rule, and more importantly, understanding the fine print behind it, can mean the difference between a smooth, stress-free sale and an unpleasant financial surprise. With the right knowledge, retirees can make informed choices, protect their savings, and enjoy their retirement with fewer worries and more peace of mind. Before we continue, I want to say something directly to you. This channel is built for people like you. People who worked hard their whole life, who want clear and honest explanations, and who don't want to be surprised by the IRS later. I don't make videos to confuse you or sell you hype. I make videos to protect your money, your retirement, and your peace of mind. If that sounds like something you want, then this channel is for you. I regularly upload videos on retirement taxes, Social Security, IRS rules, and money topics that most people don't explain in plain English. If you don't want to miss future videos like this, just hit the subscribe button now. It's free. It takes 1 second and it helps make sure these videos keep coming straight to you. I'll be uploading more on this exact topic, breaking it down step by step, so subscribing now makes it easy for you to stay updated.